In this video, we're diving into the world of monthly dividend-paying stocks. We will have a look at what they are, the pros and cons. Then I will go through a list of monthly payers and have a look at their dividend safety ratings. So, are they a golden opportunity for investors, or do they come with hidden drawbacks? Let's have a look. First, let's talk about what monthly dividend-paying stocks are. Unlike typical stocks that pay dividends quarterly, these stocks distribute dividends every month, which sounds great, but like any investment, they have the pros and cons. So let's start with the advantages. Number one, they provide a steady income stream. For retirees or anyone relying on dividend income to cover monthly expenses, this can be incredibly beneficial. Instead of waiting 3 months, you get that payment every month. Number two, compounding benefits. Reinvesting your monthly dividends can lead to faster compounding growth compared to quarterly dividends. The more frequent the payouts, the quicker you can reinvest them. Number three, reduced market timing risk. Receiving dividends more frequently means you're less exposed to market volatility. This can help smooth the ups and downs of the market. And then let's have a look at the potential downsides. First, limited selection. There are fewer companies that offer monthly dividends compared to those that pay quarterly. This can limit your investment choices and diversification options. Secondly, potential for lower quality. Some companies might offer monthly dividends to attract investors despite having weaker financials. It's crucial to do research and ensure the company's dividend is sustainable. Number three, higher costs. More frequent payouts can lead to higher administrative costs for the company, which might result in lower overall returns. Also, reinvesting dividends monthly can incur more transaction fees. And then finally, tax implications, receiving monthly dividends. Receiving monthly dividends means you'll be paying taxes on the income more frequently, unless it's in a tax-free account, which could impact your tax strategy and overall returns. So, are monthly dividend stocks right for you? It depends on your financial goals, risk tolerance, and investment strategy. They offer a unique blend of benefits and drawbacks that every investor should be careful about. There are plenty of monthly dividend stocks out there paying a very high yield. The higher the yield, the higher the risk. Simply Safe Dividends has ranked them in order, highest first. I will put the URL in the description below this video so you can have a look. They have 80 stocks listed, the top one being Orchid Island Capital with a yield of 17.03%. It cuts part of the name off in the table, as you can see, and it also cuts off the industry name here. You can actually export the CSV file, and then it will have them all listed clearly. I will flip to the CSV view to show you. Not surprising, a lot of REITs are on here, some very risky prospects, hence the high reward. You really have to do your own research and drill down in the figures if you're willing to take the leap on some of these. There are some gaps in the dividend safety column where they have not been rated yet. The majority of them have a dividend safety marked as very unsafe or unsafe. SLR Investment Corp, ticker symbol SLRC, is marked as borderline safe with a yield of 10.28%. This is no longer a monthly payer. SLR was only paying monthly dividends for 2 years, but it's just switched to quarterly, as you can see here. So let's scroll on to the next one. There are a few more borderline safe ones. EPR Properties, ticker symbol EPR, with a yield of 8.41%. Gladstone Investment Corporation, ticker symbol GAIN, with 6.94%, and Ryokan, ticker symbol RIOCF, with a yield of 6.8%, and Apple Hospitality, ticker symbol APLE, with 6.63%. Looking at the dividend history for these three companies, Gladstone Investment has been the most consistent in terms of dividend increases and also including special dividends. A special dividend is a payment made by a company to its shareholders that the company declares to be separate from the typical recurring dividend cycle. And let's see a small increase in its 12-month forecast to $14. We then move further down the list to the first dividend stock marked as safe. Some would say the king of monthly dividends, Realty Income, ticker symbol O. I talk about Realty Income a lot and personally own shares in it. If you want to know more about it, you can view these videos here. They are a dividend aristocrat, which means they have been paying dividends for at least 25 years. They've increased the dividends 125 times since its first initial public offering in 1994. Analysts see upside potential in the stock price with a 12-month price target of $59.44, an 11.94% increase. The next one on the list that is also safe is one I also own, Main Street Capital Corporation, ticker symbol MAIN, with a yield of 5.91%. I go more in depth about the stock here if you want to know more. Main Street Capital have been consistently paying dividends since 2007. There has been consistent increases and special dividends throughout the years. Analysts see minor potential upside with a target of $51, a 2.51% increase. The next safe one on the list is Agree Realty, ticker symbol ADC. Posted on Agree before if you would like to know more. The yield is 4.87%. Agree Realty started paying off dividends quarterly, having regular increases, then changing to monthly in Feb 2021. Still continuing with the increases, and they see upside potential in the stock price with a 12-month price target of $65.88, which is a 6.9% increase. Back to the list, we have three more borderline safe ones in Gladstone Land, ticker symbol LAND, Stag Industrial, ticker symbol STAG, and Whitstone REIT, ticker symbol WSR. Stag Industrial has been paying monthly since November 2013. It has seen consistent increases all the way up to present day. Gladstone Land has been a little bit inconsistent in the early days, cutting the dividend from 12 cents to 3 cents in 2014. Since then, Gladstone has had consistent increases. Whitstone was paying 9.5 cents monthly from 2012 to 2020 before cutting to 3.5 cents, then minor increases to 4.13 cents today. Not a great return at all. I used to own Stag Industrial, and out of the three, based on those stats alone, that would be the preferred choice. When you have safer options above these with a higher yield, they don't really make much sense as an investment. Then the final one is Philip Edison, ticker symbol PECO, with a yield of 3.65%. Founded in 1991, Phillips Edison and Company is an American REIT that owns and develops shopping centers throughout the United States. Looking at recent quarterly highlights, they have a total enterprise value of $6.9 billion. They have 97.2% of the portfolio leased occupancy, which is what you want to see, because less occupancy is less money. The retailers they have on board are ones that are growing at a fast rate like Chipotle and staples like Starbucks. They don't have a lot of dividend history. They only started paying in 2021, but so far so good. Currently paying 9 cents in 3/4 a month. That's the final one on the list with a safety rating. Below that, I won't go into, but feel free to have a look at the list yourself. That wraps it up for this video. As usual, thanks for watching, and I'll see you for the next one.